Hello Sector Watchers, welcome to the 36th episode of Sector Spotlight, airing on Tuesday the 23rd of June 2020. My name is Julius de Kempenaer and I'm your host for today's show, coming from a sunny Amsterdam in the Netherlands. So I thought, let me shoot some stuff outside to enjoy this nice weather. Obviously, I need to be back at my desk if we go talk about the markets overview and what has happened last week and what the outlook is for the coming week. But I also have a couple of items that I can shoot outside because they involve answering questions from the mailbag. Also, we're going to talk about a little bit more educational, going out of the box, and talk about how you can plot breadth data on relative rotation graphs to help you get a little bit of a different angle and a different way of looking at things and using those data sets. So stay tuned, stay with me, and we're going to start right away. On an asset class level, it was a pretty quiet week last week. We had a good week for stocks, up 2.2%. Government bonds unchanged, and the only negative for the week was the real estate with minus 0.7, and our benchmark came in at 1.3%. So overall, pretty good. This is the daily rotation, and you see that stocks are still rotating in a negative direction. They're still on the right hand side, but moving at a negative heading. Whereas government bonds are at a positive heading. The longer term picture is flipped around. Their stocks are still in rotation. We'll pull the longer term rotation for stocks around into negative again, or whether this is a temporary move and it will curl back up. Longer term stocks still okay. Near term stocks are losing relative strength and less relative momentum, so definitely a reason to keep an eye out there. If we quickly go to the chart of SPY, you see that the gap area came in as resistance last week. We put in a little high inside that gap and are moving a little bit lower off that gap area right now. I think we need to stay inside this trend channel and preferably get back above that gap area inside that rising channel to keep up the positive momentum for the stock market. The relative strength is already rolling over. That's what you see inside the RRG here. So keep your finger on the pulse because it's very thin ice. It can go either way. And the risk is obviously significant. The real level that I'm looking at is 295. That definitely should hold. If that breaks, we're in for another ride down, I believe. If we move to the sectors that make up this market, of course, again, a daily RRG to have a quick look at the performance of the various sectors, a little bit broader spread, bigger differences than on asset class level. A very good week for healthcare, and once again for technology and also for communication services, and a weak week for utilities and energy and real estate. What I want to do is grab back to an article that I wrote. I did a little bit of work on that a while ago. Maybe you've seen it, maybe you didn't. But I had a little bit more research done about it, and I wrote about this phenomenon about plotting breadth data on an RRG. And I think that can help you get a view at the market from a different angle. So I'm going to rearrange my screen into 3 sections, and then we're going to talk about plotting breadth on RRGs. Breadth in stock market analysis is a fascinating subject, and I've been doing some research on and off on this. I don't think I'm an expert per se, but I have found using different breadth metrics very informational in terms of looking at markets from a different perspective and getting a different angle, sometimes leading what's going on in price. I wrote an article about that in last weekend's Chart Watchers newsletter, and you see it here on the screen. And the title is Where Wall Street Meets Broad Street, Using Breadth Data to Confirm Sector Rotation. And the title came from a sentence that is often used where people say it is not the stock market but a market of stocks, pretty much saying that, you know, if the market all goes in one direction, it's the stock market is going up or the stock market is going down. I think that right now it actually pretty well timed. It is a market of stocks because you see very, very big differences in the movements of individual stocks and individual sectors. So that's why I revisited my work on breadth data. Before we start, I want to give a big shout out to our colleague here, Arthur Hill, who does a lot of work on breadth data. So if you want to learn more about that, please go visit Art's blog articles and his site. There's a ton of information on how to use different forms of breadth in your work. The one that I want to focus on today is the number of stocks trading above a certain period moving average. Now, you can imagine that when you look at the S&P 500 and you calculate the number of stocks that are trading above their 200-day exponential moving average, and you track that metric, that it gives you a pretty good idea about the participation of individual stocks in the movement of the market as such. Obviously, when that is a high percentage number, that means that there is broad participation. A lot of individual stocks are all trading above that 200-day moving average, which means that the rally is broad-based. If the market goes up, if the stock market goes up, but there is only a handful of stocks that is trading above their 200-day moving average, then that is a very narrow base for the market to move higher, so that becomes more risky. That's the way I look at market breadth. You can use that to analyze the participation in the market. Now, StockCharts has 3 sets of those metrics in their database. Stocks trading above their 200-day moving average, stocks trading above their 50-day moving average, and stocks trading above their 20-day moving average. So that's pretty much the short term, the medium term, and the long term. At least that's how I translate it. But the good news for us sector watchers is that they actually calculate those metrics per sector. So we can actually look at the percentage of stocks trading above their end-day moving average for each individual sector. And that is what I've loaded up on the screen here in the 3 sections. So on the left-hand side, we have all the sectors and the metric trading above their 200-day moving average. And obviously we compare it because we want to compare apples and apples and oranges with the number of stocks trading above their 200-day moving average in the S&P 500. So this is the whole market and these are the individual stocks. And we do the same for stocks trading above the 50-day moving average, and we do the same for stocks trading about the 20-day moving average. And then we start analyzing, and I took some time to set up the screen in 3 units because I think it gives you a good view. And what I then do is I sort all these tables on their ticker symbol, which allows me to very easily highlight or pick out individual sectors and look at the rotations. So here we've got materials, and you see that the 200-day moving average, or the 200-day RRG, is rotating from leading into weakening, whereas the 50 and the 20 days are rotating in a positive direction. So it gives me a pretty good feel that the short and the medium term are actually pretty positive for materials, and the longer term is starting to get a little bit more negative. And then of course I want to start to compare that with the rotation on the RRG itself. We don't have a lot of time. I've got a lot more to speak about in the mailbag, but I'm going to come back on this subject in future episodes of Sector Spotlight. If you have any ideas or suggestions, please send them to me in the mail. One that I want to share with you here, some that are very interesting, are for example the technology tails, and you can see that they are all traveling in the northeasterly 0 to 90 degree heading direction, which makes it a very strong and very powerful rotation. And what you ultimately want to do is bring what you see on these RRGs into or compare it to a normal RRG, and then look at the tail of the technology sector, and you can make or break your analysis and see how technology is doing. We all know that technology is doing very well. It's on the right hand side. It's the strongest sector. Look at this super short tail here, just turned back up. So technology remains the leading sector in this respect, and that's totally confirmed on all three time frames by the strong heading on these individual RRGs. We can work our way through all this. There are more metrics that we can discuss going forward. One thing that I want to share with you is I always plot these on the daily time frame, because you will see that when you do it on a weekly time frame that you will get very big hooks, and the reason for that is that the analysis time frame is pretty much embedded in the ticker symbol here, because we look at 200 days, 50 days and 20 days. So because they are metrics that are calculated on a daily basis, I prefer to plot them on a daily RRG to get a little bit smoother movements of the tails, and gives me better way of analyzing this. Please go out there, play with it. If you go into the article that I wrote and you click on this RRG, you will be able to open up a live version, and you can save this URL as a book. The first question that I'd like to answer is from Terence. It's a pretty big, well, it's half-page message, email, and the first part is about RRGs and where they are available. So pretty much the answer on Sector Spotlight, which is airing on StockCharts TV, is they are available on StockCharts.com. It is, by the way, the primary location for any web-based implementation of RRG. The second part is the real question and the interesting question, and let me read that out to you. Another question that I've always pondered is: performing technical analysis on the VIX even valid? Classical TA involves analyzing trade prices on actual assets, Japanese rice, for example. The VIX, in my opinion, isn't a true asset that is bought and sold in itself, even though people obviously buy options on the VIX, etc. At the end of the day, the VIX itself doesn't have the same forces of supply and demand that stocks and commodities, etc. do, and therefore I never thought of it as something that can be charted in the same way. Any thoughts? Please also correct me if I am wrong. Hoping you could discuss this on one of the shows sometime soon. Yeah, that works, because the mail came in at the end of May, so that's in a few weeks. That's soon enough. And it's a timeless question, because the short answer is I agree with Terence, but let me elaborate a little bit on that. I think that technical analysis should only be applied to items that you can actually buy and sell, and as Terence described it, the forces of supply and demand are in effect. Now, you can trade the VIX. You can trade futures and options on the VIX, and maybe there is an ETF, I don't even know. However, the VIX is a derived index. It measures the implied volatility of a range of traded options, and in that respect it is a very valuable asset for us as investors, because it gives us an idea about the volatility in the overall market and are dealing with, and what options traders are pricing into the price of their options. But it's not like I buy the VIX index or I sell the VIX index. It's not like that supply. It's a result of something. It's a result of a lot of data into options. And I think I'd be very, very, very reluctant. I would never do it, but I'd be very reluctant to advise someone to, let's say, draw an RSI on the VIX index or draw support and resistance on the VIX index, because it just doesn't really do that. For the same reason, I would not advise people to look at, let's say, the price of an individual option. Let's say the 3,300 calls on SPY, or the 3,300 calls on the S&P 500. Why? Because the pricing of those options, or the VIX for that matter, completely depends on what happens with the underlying value. And the underlying value for the VIX are a lot of option series, at-the-money option series. The underlying value for the 3,300 calls is the price of the S&P 500 itself. So you should do your analysis on the asset itself, on the tradable asset. And in the options example, that is the S&P 500. And the pricing of that option is largely depending on the underlying value and movement of the S&P 500, and then obviously some financing rates of interest and the volatility. But don't get a chart of an option price, or don't get a chart of the VIX and start drawing trend lines, for example, because that just really doesn't do it. What springs to mind is, I haven't done it, but go back into the blogs of Greg Morris, who I love his writing style. He can be pretty straightforward and, telling you whether you're correct or whether you're talking BS. And I'm pretty sure you will find articles or statements by Greg that you actually need to be able to trade an underlying value in order for it to be able to apply technical analysis to it and draw your indicators and your trend lines, etc., etc. So supply and the forces of supply and demand need to be there. Anyway, pretty long answer to a question. What I think about it? Well, my thought is, don't use charts of the VIX or any derived instrument directly to mark support and resistance. Always go back to the underlying tradable asset, i.e. a stock, an index, a commodity, a bond, etc., etc., etc. As long as you can buy and sell that, you can, as long as forces of supply and demand are directly involved. I think that's the best way to say it. Forces of supply and demand are directly involved, then we can apply all our magic with our technical analysis charts. So thank you, Terence, for asking this question. I think it was a great question, and for all of you, if you have any of those questions, whether they're related to RRG or only remotely related to RRG or relative strength or technical analysis, and you would like me to answer them, please send me an email at juliusdk@stockcharts.com, and I'll be happy to discuss your questions in the next episode of Sector Spotlight. Now, the second question that came in is from Mr. Patel. You may have noticed that most of the time I talk about questions that came in, I always use the person's first name so they actually know that their question has been answered, and I don't want to invade anyone's privacy too much. Now, Patel is a very, very common name, so I don't think that now anyone is going to go to Mr. Patel's front door. But I love this question. He loves the markets, etc., etc. And then he says, I'm a senior, now watch this, 87 years old, 87 years on this earth. And I have studied markets since 1970. 1970, my God, I was 7 years old in 1970. I didn't even know what a stock was or what an option was. But then his observation is, I cannot figure out why and who opens the market instantly high, for example on the 16th of June. It opened high and traded overall down all day, which I consider distribution rather than accumulation. Please enlighten me on this issue. Greatly appreciated. Now, someone who's 87 years old deserves our respect and deserves an answer. And the one thing that I needed to think about when this email came in is there's actually two conversations that I had with a guy called Mike Epstein. Well, he passed away, I don't know, many years ago. I met him a few times at conferences, and Mike at that time, which is I think maybe even 10 years ago, was already old. He was in his 80s. But he was a great character and a great technician. And I had discussions with him. It was always good fun. And then he ran a brokerage firm. He owned a brokerage firm or ran a I don't know, but he was high up in the ranks of a brokerage firm. Did a lot of technical analysis. And I was speaking with another person who knew Mike very well, and he was telling me a story that at that time, Wall Street was all gung-ho and young people coming in, and they were working 6 in the morning to whatever time in the evening, banging very, very hard. And he told me a story that in that office where Mike was working, there were some youngsters who were complaining about Mike coming in what they consider to be late, probably 8:30, and maybe sometimes leave early. And then he told me that the answer to those kids was, what are you talking about? The guy comes into the office. He is 80-something years old and he comes into the office. Think about that. And that was the end of the story. And I thought that was like, all right, if you're doing this for so long, give him a little bit of slack. The question of Mr. Patel strikes my interest because, and I got to go back to my desk and bring up an article that I recently read, which describes how if you break down the performance of the S&P 500 in the performance that was made during trading hours and the performance that was made outside trading hours, so from closing to opening overnight, that is a big difference, and it is super interesting to watch. And I'm going to go back to my desk and bring up that article right now. And here is the article that I was just referring to. It's actually an article that appeared in the New York Times, and the title is that the stock market works by day, but it loves the night. And striking is that this was actually already published in 2018, at the start of 2018. And what it did is it's actually based on a strategy that is promoted or developed by BIG, the Bespoke Investment Group. And what they did is they looked at the returns if you would buy at the open and sell at the close, or if you would buy at the close and sell at the next day's open, and then comparing the results of both strategies. It's a very interesting article. I suggest you go look it up. Just Google this title and it pops up immediately. It's a pretty long article, but what they found is that the results of the overnight or the outside hours strategy beats the daytime strategy, so the trading hour strategy, hands down. It's there, it's undeniable, but the article says that the scientists and the people who've been researching it have not yet been able to actually explain exactly why. So here is like, we don't know exactly why that is going on, but it's the exact same observation that Mr. Patel made. He said we gap open and then we go down during the day. There's a couple of interesting graphs in this article that I want to share with you. Here is the two strategies. This is the outside regular trading hours, and this is the regular hours since 1993. Whoa, look at that. If you would have done that every day, if you would have since 1993 bought every opening and sold every close, you would have been down, sort of unchanged, down. While doing it the other way around, so buying at the close and selling at the next day's open, you would have made almost 600%. Now that's a serious change. So it is a factor to actually be aware of, keep in the back of your mind, and it's actually in favor of people who are holding positions a little bit longer term, and it goes against the day trading stuff. Now the article also explains that there are a lot of people and a lot of strategies that made a lot of money day trading, but this is for the, let's say, the lazier people among us, or people who don't want to make things too complicated. This is something that you actually want to keep in the back of your mind. And another thing that struck me was a phrase down here where it says, yeah, here it is. This is an interesting observation. It has looked at the data during the bear market of 2008. The overall market declined 36.8%, but most of the damage occurred during the day, which was amounting to almost 27% of the decline, with only 14% overnight. So it's an interesting metric, and it probably explains here, as said, that when the market is open, maybe a lot of people are reacting in a very primary fashion. They see bad news, they hit the button, they start selling, causing those declines. As where the news happens overnight, they have a little bit more time to think about it. Asian markets, maybe European markets were open. They've been digesting the news, and the response to the news is a little bit more mild and numb. But I thought this was a very interesting article that made a bridge with the question of Mr. Patel, who observed that, you got the gap opening and then you got the distribution, which pretty much ties in with the observations in this article. So if you're interested in that, please go to the New York Times site and find the article, and it will also be able as an update on the bespokepremium.com website of Bespoke Investment Group. Very interesting stuff to keep an eye on. And that's it, ladies and gentlemen. This was Sector Spotlight. I hope you enjoyed the show. If you did, please don't forget to give us a thumbs up. And if you have any questions, please use the comment section below the video. I will personally answer every question or suggestion that comes in. Sector Spotlight airs every Tuesday from 10:30 to 11 a.m.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.